Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Air Canada are moving higher, about 2.2% right now, let's say, after the national airline posted higher than expected revenue and profit in the fourth quarter. Air Canada says the results were driven by growth in domestic and Atlantic travel, which offset weakness in travel between Canada and the U.S. There was also stronger than expected demand across both cargo and passenger segments. Magna International is the best performing stock on the TSX today. It's up, look at that, nearly 16%. The auto parts supplier boosted its revenue and profit forecast for the full year after beating on the top and bottom lines in its latest quarter. Magna now sees revenue of up to $43.5 billion US despite the decline in global vehicle production. Magna says it expects about 15 million vehicles to be produced in North America this year. Shares of Agnico Eagle Mine, they are edging higher as well, up about 3.5 right now. That's after the company beat profit estimates in its fourth quarter and saw revenue for mining operations come in above consensus. A bright spot in the quarter was Agnico's gold output. The company has now surpassed Barrick to become the world's second biggest gold producer. To the markets now, the roller coaster continues. The TSX has now jumped. It's up 1.3% on this Friday after that big sell-off yesterday. South of the border, they are all in the green as well. Again, they had an up and down day yesterday, but you can see the S&P 500 up by a quarter point. The Dow by 0.2. NASDAQ about a wash right now, but it's still ever so slightly in the green. And part of that reaction is to the U.S. inflation numbers. It eased in January with prices rising about 2.4% year over year, but questions remain about whether this signals the start of a broader easing trend or just a one-off move. To break this down, we're joined now by David Doyle, head of economics at Macquarie Group. And David, thank you very much for joining us.
Thanks for having me.
All right. It was a little less than what the analysts were predicting. And any surprises, though? Is it in line?
Yeah, I mean, I would describe those numbers as being roughly in line. There was a little bit of a downside surprise in terms of the headline number, primarily due to softer than expected gasoline prices. It looks like those will rebound when we get the February report in another month or so. And so I think that'll just wash out. The core number, which of course most people are most focused on for the implications for monetary policy, was right in line with the consensus, almost exactly in line with that. In terms of the description there, a lot of it seemed to come from this core services X shelter type measure, which showed a steep acceleration. Airline fares, for example, was a big contributor to that component. But again, I think that there's some caution in terms of interpreting that as a signal. There's some evidence that perhaps there's still residual seasonality in the data. We also showed strong increases in that measure that I'm referencing in January of 25 and in January 24. So interpreting the data cautiously, but it does look like it's in line.
All right. And one of those, I guess, where did housing fall in with this, and what is housing looking like within CPI?
So yeah, rent and both rent and owner's equivalent rent, which are the big components for housing, were moderate. They're in around 0.2, 0.25% month on month. So that's an encouraging sign. We've seen that those measures have largely come in year over year. So they're no longer the disproportionate drivers of consumer price inflation that they were, a year or two ago. They're effectively on a year-over-year basis very close to where they were pre-pandemic. There may be more scope for them to fall further year over year, but we think you're in the later innings of disinflation from those sources.
And what does that tell you about the housing market and where people's mindsets are at?
Look, I think the big thing and the big takeaway that I would have from what's going on in U.S. housing, it relates to immigration policy, right? So we've seen, massive change in immigration policy over the last year. and as a result of that, the population growth, household formation is much lower than what it was previously. And I think that's been a big factor that's taken a lot of the heat, or contributed to taking the heat out of housing inflation. It's caused, I think, less demand than what you would have seen otherwise.
All right. One of the numbers, it looks like it's standing out. Energy prices off 1.5%. What do we know the factors to that?
Yeah, so as I mentioned, the gasoline prices were the big driver there. You saw gasoline prices on a monthly average basis decline in January versus December. But again, given the recent strength we've seen in the oil price, and that's now passed through to gasoline, I'd expect that to reverse with the February data when it's released in a month's time. So you probably will get a strong impulse from gasoline in the next report.
All right. And as we start moving further into 2026, any indicators on which way this might head?
Look, I think the one thing that we haven't discussed in detail yet is the goods component, right? Of course, goods related to the tariffs. The core goods was flat month over month, but I think that that's a bit misleading. Used cars and trucks, which is a very volatile category, and of course not as impacted by tariffs and/or trade, was a significant downward contributor. So what our team likes to do is we like to strip out the impact of used cars and trucks. And when you look at core goods, excluding used cars and trucks, it was very strong at 0.4% month over month or so. That was the strongest reading in that component in, I think, 3 years. So some signs there that we're still seeing tariff price pass through, given what's occurred over the last year.
Okay, and of course, all this leads to the question: what about the Fed?
Yeah, for the Fed, I mean, look, the market yields, I think, have come in since the report. So I think maybe even though the consensus was, roughly in line with it, markets may have feared a somewhat worse reading. For the Fed, I think they're in wait and see mode. So it's really going to be dependent on the data. I don't think these inflation numbers will sway hawks or doves one way or the other. I actually think the bigger driver of Fed policy looking ahead will be the labor market. And as we all saw back on Wednesday, we did get some encouraging numbers on that front, and some in sort of an improved pace in terms of the trajectory that we're seeing in jobs growth and a lower unemployment rate. I think those will be front and center at the discussion when the Fed meets in March. But of course, we get another report, employment report in advance of that, so that could change things as well.
All right, and just kind of I'm going to roll in the Canadian economy with the U.S. economy. What are we looking at over the next few weeks, the next few months?
So look, I think for Canada, the big thing this year, of course, is what's going on with the trade relationship with the U.S. and how that is evolving, and of course the negotiation that's in place in terms of whether or not to extend the USMCA/CUSMA. So that I think is something that's going to have a big impact, or could have a big impact, on fixed business investment. But even without sort of resolution on that front, I do think that there's cause for optimism on Canadian fixed business investment. The federal budget that was tabled last fall included a bunch of measures designed to accelerate business investment, such as accelerated depreciation. So we do think that there's cause for optimism on fixed business investment. The other, I think, a notable thing for Canada, it's actually similar to the U.S. in this front, is that we've had quite a shift in our immigration policy as well. So one of the things that we've been counseling our clients on is that break-even employment growth in Canada, may be as low as just zero. Right. So we may not need to add any jobs per month in order to hold steady the unemployment rate. So if we do see the labor market in Canada pick up, it's possible that we see the unemployment rate here fall quite sharply. And so that's a scenario that we think people should be prepared for.
Okay, we have to wrap it up there. But David, thank you very much for joining us.
Thanks for having me anytime.
David Doyle is head of economics at the Macquarie Group. Coming up, shares of Airbnb are moving higher after the company's Q4 revenue estimates and Q1 revenue forecast came in above expectations. We'll break that down next. Airbnb shares are up after the company reported fourth quarter results that beat expectations and issued a first quarter revenue forecast that topped analyst estimates. The vacation rental platform is betting on premium travelers and expansion into hotels to offset softer demand from more cost-conscious customers. Joining us now to break this all down, Ronald Josie, Managing Director at Citigroup. Ronald, thanks very much for joining us.
Thanks for having me.
All right. What are some of the numbers you like? What are some of the numbers that might be a little concerning to you?
Yeah, look, I think going into this print, there's a lot of unease on just everything related to AI and the disruption across most every single vertical. Travel notwithstanding, based on the research we've done, based on other news out there, travel is a top thing, a top vertical that people search on OpenAI or ChatGPT, on Gemini, and all these different chatbots. And so there's a lot of concern going into this quarter about what the potential impact has been or what it can be over the next couple of years. And what we got coming out of this quarter was accelerating room nights growth. They call it nights and seats booked growth. What we saw was improving overall gross bookings and revenue and profitability that was in line. But most importantly, the travel market feels like it has very strong momentum in 4Q that has continued into 1Q. And I think the number one thing taking out of this quarter is the improvements that Airbnb have done on the product side. So their own changes, notwithstanding what's going on in the market, notwithstanding the AI fear, but the changes around reserve now, paid later, around more transparent cancellation policies, around improved pricing for the hosts, all these things are actually adding to room night growth. And we think that can continue, particularly if as the World Cup comes on and these other larger global events take place. So, our takeaway from the quarter is travel demand seems to be in a good position. It's continuing into 1Q from a macro perspective. And Airbnb is launching newer products that are helping to drive greater overall growth and accelerating growth in their core nights booked or basically nights and seats booked metric.
Any concerns that it seems to be the premium travelers that are bringing the money in, this K-shaped economy kind of coming back in here? Any worries about that, or is that something that there's room to grow with?
Yeah, I mean, look, it seems as if there's a lot of things to worry about overall macro and AI being one of them. It's interesting. 3Q travel trends were better. That clearly continued into 4Q, and it seems as if that's continuing here this quarter as well. From a K-shaped perspective, there's a lot of insights and thoughts around what that means to the broader travel trends. But frankly, I mean, we're seeing greater overall results across the board. And so Airbnb is benefiting from whomever it is that's spending these dollars. The K-shape is certainly one of them. But I think there's this broader demand for travel, and it's sustaining the pricing power and also just the supply that's out there.
And were the nights booked, was it pretty much across the board? Were there hotspots for it, like location, regions and locations?
That's a great question. I mean, it's funny. It's interesting. So the U.S. was a good market. I think nights booked rose about mid-single digits. We call that 5%. But really, the standouts in our view were EMEA as well as Latin America. And the news out of Latin America, and maybe this is a broader picture, the news out of Latin America is Brazil is now a top 5 country. And so a few years ago, Airbnb was clear to say 75% of overall gross bookings came from their core 5 markets: US, France, Canada, Australia, UK, as an example. And they were really focusing on these next 9 markets, which Brazil was one of them. Fast forward 2 years later, after these investments in supply, generating greater demand, et cetera, Brazil is now a top 5 market. And so LATAM saw accelerating growth, I think, in the high teens. And I think you're going to see that playbook, although every country is different, but that playbook that they put through in Brazil replicated across some of their newer emerging markets like Germany and Italy, like Japan and others in Asia as well, Mexico and in LATAM too.
And I think you said France was one of the top 5, but Germany was not. Why is there such a discrepancy between the European countries?
Yeah, I mean, it gets into nights booked. Country of origin from nights booked is the way to think about it. And for some reason, France, UK have adopted Airbnb for years. You would have thought Italy and Germany and Spain, for that matter, would be larger, but they're more destinations as opposed to traveling out. And I think that's where Airbnb is really trying to make sure they're both destinations, but also origins of room nights booked. And there's different cultures. Germans are very different than French, et cetera, that I think they need to do some product changes that they've done. And now it's a matter of time before, more countries can start contributing to overall gross bookings and nights booked growth.
And they're pushing into hotels? How's that working?
Yeah. It's funny. Of all the things that I mentioned, right? Better macro, reserve now, pay later, new host pricing. I didn't mention hotels. I think from a hotel perspective, it's new, right?
Yeah.
And as well as services and experience, these are new opportunities for Airbnb. Historically, hotels have always been for, call it, overflow, or where perhaps there wasn't as much supply. Now it's as part of the overall trip. If you fly into a city like Madrid, for example, or Paris, but your end destination is, call it, Annecy or somewhere else in France, maybe you spend the night in that major airport, whether it be Paris or Geneva or whatever, at a hotel, and then you get ultimately to your Airbnb, to your rental. And so, hotels are a means to a broader end, as well as just basically offering more services to every traveler.
Okay, we have to wrap it up there, Ronald, but thanks very much for joining us. Appreciate it.
Thanks for having me.
Ronald Josie is Managing Director at Citigroup. Coming up, Sun Life topped estimates in its latest quarter. We'll hear from the company's CFO when we come back. Financial services company Sun Life has reported strong earnings amid robust sales in Asia and the U.S., as well as solid wealth sales in Canada. We sat down earlier with Tim Deacon, CFO of Sun Life, to discuss the recent quarter.
We had a really strong finish to the year overall for Sun Life. We had $1.1 billion of underlying net income. That was up 13% year on year. Underlying earnings per share was up 17%. So really, really strong finish. And a large part of that was the U.S. In that segment, earnings were up 30% year on year. And a large part of that has been the performance on our medical stop loss business, as you noted. Sales were also up in that business. We had record sales for that business as we start to see a hardening part of that market. Now, medical stop loss is an important segment. This really is for employers who, the majority of employers in the U.S., they self-fund their medical benefits, meaning they cover the first dollar of loss. And then when claims exceed a certain threshold, they'll seek stop loss coverage. And that's the business that we provide. We've been in that business for nearly 4 decades, and we're the largest independent writer of medical stop loss. So we have a lot of large scale. And we saw in the industry, with the increase in medical costs and claims coming out of COVID, the industry saw claims experience spike in 2024. And that started to stabilize through 2025. And what you're seeing in our results is that stabilization, and also recognizing the strength and the scale that we have, both in the discipline and underwriting that business, as well as in pricing it.
Is that something you can predict?
It has a difficulty in predicting because it's a stop-loss protection. That means that the claims have to hit a certain threshold before this insurance coverage comes in. And that's what surprised the industry in 2024. Late in that year, there was a large amount of claims, and they're mostly late-stage cancer diagnosis. These were individuals who, through COVID, couldn't get access to preventative screening, and so therefore became sick when they were finally diagnosed, and those claims became quite expensive. The way the health system works in the U.S., that sometimes takes a while to accumulate. So that was the surprise for the industry in 2024. With our data and our underwriting, we have an ability to predict the trends that come through on that business. And we've seen that part stabilize. And also in our risk selection, when we look at the types of risks that we're underwriting, we've had a chance to look at and better predict that.
Got it. Okay, let's get to Medicaid sales also being up for you in the U.S. Would that be more people coming in or more work per person?
So our Medicaid business is, for us, really in the dental benefits side of our business. We have 3 business lines. We have employee benefits, the medical stop loss, which I just spoke about, and then the dental benefits. And for dental, we're the largest dental benefits provider in the U.S., and the Medicaid part of the business is a significant portion of that. The sales that we saw in this quarter were of state contracts. So these are states that are covering the lower income earners in the U.S., and so these are individuals who need healthcare protection, and in our case, we provide them dental benefits. We had gone into the market with a plan to reprice. This business reprices every year, and so we had a chance to reflect the increased claims that we were seeing through 2025 in those sales, and are expecting to continue to grow that business going forward.
So sorry, the metric we just had up was that it was up 48%. So that is because the cost for the services went up or more people came through?
So for the claims actually had stabilized for us. So that 43% is entirety of the overall U.S. business. So our claims on our dental side, they spiked in the second quarter and then through to the third quarter of last year. They've stabilized in Q4. So we're actually not seeing an increase in claims going forward. So instead, we're writing new business on the expectation of stabilized claims.
Okay, let's get to Canada, because I know your wealth asset management did well in this country. How much new money came in?
So we had strong flows in our wealth and asset management businesses in Canada. We're the largest writer of group retirement business. That's now 200 billion of AUM. We had positive wealth flows coming into that business. We also saw positive flows in mutual funds and in our wealth protection products as well. In Canada overall, earnings were up 14% year over year. That's a really strong result for our home market. It's a mature market, as you know. Our medium-term earnings objective for our Canadian business is 6%, so we're well ahead of that. And that was on the large part of the growth in the wealth side of the business, as well as continued positive experience on our health side of the business as well.
Let's get to Asia quickly. Individual protection is up. Can you tell me how much of your business Asia is, how much it comprises compared to North America?
Our Asia business is a really important part of our growth for our company. We're in 8 different markets across Asia. It's about 20% of our earnings overall. It was up significantly year on year, really on the back of strong growth and sales in our Hong Kong market, which is our largest market there, as well as on Indonesia. So in Hong Kong alone, sales were up 111% year on year. And in Indonesia, it was 43%.
What will be the focus for the company this coming year?
We have 3 main priorities. The first is to continue to grow our wealth and asset management part of our business. We're Canada's largest asset manager at 1.6 trillion of assets under management. That makes us a top 25 asset manager globally. Last quarter, we announced the creation of a new asset management pillar where we're bringing together all of our private asset capabilities as well as our public equity and fixed income capabilities under MFS, under one umbrella. And our key focus for that is to help grow that part of the business. We expect that could be almost 50% of our earnings over time. The second priority that we have is to continue to invest in digital and AI. We see tremendous opportunities and benefits as we continue to automate our back offices and to provide better seamless client experiences. And our third priority is to continue to focus on the turnaround of our dental business in light of the Medicaid performance that we spoke about earlier.
Morella was speaking with Tim Deacon, the CFO of Sun Life. Coming up, shares of Magna International are surging after the auto parts giant beat fourth quarter estimates. We'll get more on that when we come back. Colliers International is the biggest laggard on the TSX today, down more than 10% right now after the real estate company reported profit for its most recent quarter that came in below expectations. Profit was dragged lower by Colliers' engineering and investment management units. The company also says the acquisition of IESA Engineering is expected to impact the second quarter. Shares of TC Energy are getting a boost. That's after the Canadian energy firm saw a profit and revenue in its latest quarter, top expectations. Natural gas pipeline deliveries in Canada also rose 5%, setting a new all-time high. TC Energy also raising its dividend by 3.2%. Shares of Enbridge are edging higher today. The energy company posted fourth quarter profit that rose 17%, driven by expanded operations and lower U.S. taxes. As a result, Enbridge has reaffirmed its 2026 targets, with the top end of its earnings outlook coming in above expectations. The quarter was also driven by major partnerships with Meta in the power space. And what a swing from yesterday's in the red day. You can see the TSX has bounced back. It's up almost 1.6% right now. And the U.S. market's reacting to the inflation news. It was a bit of a yo-yo, but they were in the green last time we checked. Let's see how they're doing right now. Okay, the Nasdaq's been floating right along a wash, a flat day for it, but you can see the S&P 500 up by 0.28 and the Dow up by 0.26. Despite U.S. tariffs and uncertainty around the future of CUSMA, Canadian automotive supplier Magna International delivered a solid beat in Q4 and introduced stronger than expected guidance for 2026. For more on this, we were joined earlier by Jonathan Goldman, analyst, Diversified Industries Equity Research at Scotia Capital.
What's been carrying the performance all year is the company's ability to control what it can control. So I think in your opening, you alluded to the tariffs and the challenging operating environment. Part of that is vehicle prices going up. So you don't really have any control on how many units you're going to produce. But what you can do is you can look at costs or operational excellence, managing workflow, optimization, procurement, and really controlling your side of the ledger on that regard. And they've done a fantastic job on doing that and driving margin expansion when normally you would need vehicle volumes to increase to do that. And they've still managed to do it every year, and they're still going to do it going forward. And it seems to be a core part of the strategy now. So pretty optimistic about next year and likely good visibility in them achieving those targets.
But what's interesting is Magna's 2026 guidance excludes the impact of tariffs or uncertainty over CUSMA renewal. We've got that renegotiation coming up in the summer. How realistic is that outlook to exclude those things?
It's a good question. There was some impact of tariffs last year. So I think they talked about a 10 basis point headwind on margins from tariffs. I mean, some of them they had to absorb. Some of them you did have commercial recoveries from customers, which is built into contracts. It's a very fluid environment, as you know. Things could change at any second, depending on what comes out on the social media cycle. It's tough to put in a model that for a company or for anyone on what the impact could be. They do have pretty robust mechanisms to recover price from their customers. And what I would say on the renewal of the CUSMA, it is a risk to the story, and I would say the industry generally, but it's in everyone's benefit to work together. As you know and your viewers know, it's a very integrated supply chain with things going back and forth across the border 6 and 7 times, also with Mexico as well. So maybe it gets reworked a bit. I've heard it's focused a lot on assembly rather than production, which would kind of exclude Magna. But it seems to me that everyone is kind of to their benefit to come to a solution that works with everybody, so no one actually has to pay higher for cars.
Yeah, it's hard to kind of untangle yourself from a supply chain that's so intertwined, as you mentioned, right? Is that why you've maintained a sector perform rating on the stock? Like, what's holding you back from being a little more bullish on Magna?
Yeah, I guess I would take a step back and I would say I'm a little less bullish on the sector versus Magna specifically. I would say Magna this quarter, and I mean, I guess throughout 2025 has delivered and exceeded my expectations and the street expectations, and clearly again today. And it's nice to see the market rewarding them. My view on the sector is the input costs to make cars. I mean, we saw the announcement this morning on Trump potentially rolling back steel and aluminum tariffs. But labor has increased, other input costs have increased, freight has increased. There is some level of tariffs right now that are being baked into the cost of manufacturing a car. You could only absorb so much of that if you're a manufacturer, if you're a supplier, because the margins are very thin, as you know. Some of those costs will eventually get passed on to the consumer, I believe. And it's one of the most expensive items you can buy, you know, maybe outside of a home. Any increase in the price has a negative impact on demand. So that's always the risk we're running right now. If you see some more inflation, if the prices go up, you could see a negative impact on demand. And I guess just for context, I think the average price of a car right now in the US has crossed $50,000 US, and the average monthly payment is US $800. So that's quite a bit of chunk of change for the average household.
Yeah, and as you say, like, it's so hard for businesses. You know, we've seen so many Canadian businesses, at least, and probably American as well, trying to absorb the cost of these tariffs for the consumer. So you're not passing that along, as you say, but they can only do that for so long. Is that right?
Exactly. I mean, if you look at the OEM margins, they've come up a lot in the past year. I think we're back or even below the 2019 levels. And that does come at the expense of other things in the supply chain. So between the consumer, the suppliers, the OEMs, even miners, throughout that supply chain, the higher costs by tariff need to be borne by someone. Thus far, it's been mostly the OEMs. The risk then is if they pass it on to the consumers and suppliers to bear in some of those costs.
We know the Prime Minister, Mark Carney, laid out a new strategy last week when it comes to the kind of auto industry, very much focused around electric vehicles, also a potential decoupling from the U.S. There was a couple of things mentioned in his announcement last week, but I'm wondering how much of that affects Magna in particular, do you think?
It would probably affect the entire industry. I guess if we take a step back, I think the bigger question, rather than where the manufacturing is coming from or where the vehicles are coming from, is the outlook for EVs generally. So you've seen some pretty big announcements from OEMs recently about taking write-downs and reshifting some of their focus to ICE vehicles, the traditional ICE-powered cars. I think that's the bigger question the industry is facing right now. We've seen the adoption curve kind of slow. Obviously, EVs are more expensive, and we talked earlier about these price and affordability challenges. I think before we even get into manufacturing and sourcing and geography and tariffs and those types of conversations, I think the industry really needs to recalibrate the level of EV penetration that we're going to see going forward. So I think there's a bit of a shift that's still happening right there. Maybe it comes down further. Maybe we've stabilized. But I think that's the main challenge the industry is facing, rather than where the vehicles are coming from at this point.
And just very, very quickly, like, where does Magna sit in comparison with its competitors? Because I know you said, the whole sector is going through this, but where does Magna sit in comparison?
Magna is the leading NA North American supplier. They're the largest tier one North America, I believe, number 4 in the world. So these guys are at the forefront of anything. Mm-hmm. They are effectively the industry bellwether as far as the supplier goes. Obviously, you have your D3, your Ford, your GM, and your Stellantis. Magna is effectively that big in terms of the supply chain and supplier base, the tier one. So they really do set the tone for the industry. Everyone looks for them on guidance, outlook, and kind of having their ear on the ground of what's coming next.
Lindsay was talking to Jonathan Goldman, analyst of Diversified Industries Equity Research at Scotia Capital. Coming up, we'll get further insights into Manulife's latest quarter. That's next. In its latest quarter, Canadian insurance company Manulife Investments announced a new mutual funds, plural, to bring additional access to investors. We sat down earlier with Colin Simpson, Chief Financial Officer at Manulife, to discuss the latest quarter.
We were really happy with our numbers. We saw earnings go up by 5%, and on a per share basis, up by 9%. We felt so confident in our outlook, we increased the dividend by 10% and announced a new share buyback of 2.5% of the company. So things went really well for us in the quarter. I think the reception to the results and the results in share price decline, some of that was due to softer Asia sales than we've seen in the past. We'll always prioritize value over volume. So, we certainly weren't concerned with our Asia numbers. And in fact, Asia earnings were up 24%. The other area that got some questioning on the call was we saw $9.5 billion of net outflows in our asset management business. But this was largely a function of what we're seeing in the market and some very seasonal retirement fund flows. So when you put that to one side, really strong earnings growth out of our asset management business. So feeling really good about the quarter and looking forward to the near future, really. Mm-hmm.
And I don't want to take away from the positives of this report, but you did mention, sales in Asia, sales in Hong Kong in particular were down in Q4. Despite strong performance throughout the year in Asia. So what do you make of that? What drove those sales being down, do you think, in that quarter?
Yeah, and we saw in Hong Kong, we sell through a variety of different distribution channels. So we have our own agents that sell our products. We have banks, and then we have independent agents. And what we saw this quarter was that independent agent channel having a tougher period for us. And part of that is there's been some regulation change. And so there was a little bit of disruption in that channel. Now, the important thing to note is that our own proprietary channel and the bank channels have higher margins. So while sales were down in Hong Kong quarter over quarter, margin was up really strongly. Actually, we had a 52.4% margin. A year ago, that margin was 39.7%. So when you take a step back, actually, and look at the overall sales growth in Hong Kong for the full year, it was up 21%. And that sort of demonstrates that the comparator was quite tough for our Q4 numbers.
Manulife also announcing that you're launching ETF-based mutual funds. Tell us more about that and what investors can expect from that.
Yeah, we want to be the number one choice for customers. And so our drive is to provide customers how they want to invest, what they want to invest. We want to give them as broad an opportunity as possible to invest. And ETFs are a core part of our product offering. And in fact, through John Hancock, the brand that we trade in the US, and through Manulife in Canada, we're able to offer ETFs to give customers that extra choice. When you look at what we offer as a company, we go all along the credit, equity, and infrastructure spectrum. We've got a fully illiquid private credit business that we offer through our Comvest Credit Partners. We've got semi-liquid through CQS based out of London. And then we've got the broad-based Manulife funds that offer public credit with a fantastic track record. So you put all that together on top of really great infrastructure opportunities, and you add the option for customers to invest via ETFs. And we think Manulife is a fantastic option for our customers.
You also announced a new global credit strategy, a couple of announcements yesterday. So tell us more about this strategy.
The global credit strategy, look, there's no real change to global credit for Manulife. We remain very constructive, and we pursue a diversified strategy. We operate in in 14 different countries in Asia. So having people on the ground really gives us that opportunity to assess credit as it happens on the ground, gives us great knowledge locally, and you put all that together, and we remain relatively constructive on the credit space. We do think that the economy will not necessarily struggle too much in 2025, 26, but it's certainly not going to be, a blowout year. And so things like the short-term interest rate, we expect it to remain fairly constant until well into 2027 here in Canada, and that's really reflecting a credit environment that will continue to muddle along, I think.
Is that one of the headwinds, if you want to call it a headwind, that you're anticipating in 2026? I was going to ask you what challenges you see lie ahead for Manulife, and the economy kind of, as you say, like muddling along, maybe could be one of those potential challenges?
Yeah, the great thing about a life insurance company is that a lot of our earnings stream comes from business that we've already written. And so, when you think about some of the challenges, some of the macroeconomic challenges and the geopolitical concerns, that doesn't really impact our earnings per se. But should we see leakage of that into the credit markets, certainly I think the whole financial services sector could see that as a challenge. But I will say, we operate really in the public credit space, so quite high up in the quality spectrum. And in fact, we had a really good credit experience in the fourth quarter, and that's reflective of the fairly benign credit environment, particularly in the public space where we operate.
That's Colin Simpson, the Chief Financial Officer at Manulife. Coming up, the U.S. House of Representatives has passed a resolution against U.S. President Donald Trump's tariffs on Canadian goods. We'll find out more after the break. The U.S. House of Representatives has passed a resolution against U.S. President Donald Trump's tariffs on Canadian goods, delivering a message to the administration for launching that trade war nearly a year ago against Canada. CTV's Rachel Aiello has more.
The joint resolution is passed.
By a vote of 219 to 211, the U.S. House passed a resolution to repeal President Donald Trump's so-called fentanyl tariffs levied last year, citing border security. These 6 House Republicans breaking ranks to join the Democrats in backing the move.
This is the right vote for my district. These tariffs are hurting them, and again, that certainly weighed in my vote on this.
Well, I've got to represent my district, and Canada and the state of Washington have very close trading relationship. It's valuable.
And while largely symbolic, it's a sign some Republican support for Trump's use of emergency powers is slipping.
I think it's an early indication that over the course of the next 6 months, we're going to see a little more month-by-month erosion in the support for the president among the Republican caucus, both in the House and the Senate.
Defending his trade agenda, Trump said any Republican in the House or the Senate that votes against tariffs will seriously suffer the consequences.
I'm disappointed in the vote, but the president has veto power.
The resolution now goes to the Senate, but without the two-thirds majority needed to override Trump's expected veto, the tariff policy won't change.
So it's a good step, but it's a small step.
Still, experts say it positions Canada better heading into the CUSMA review.
I think it actually gives Canada a little bit of additional negotiating power, right? But it just highlights to the president and to the U.S. administration that Canada has allies here.
The U.S. Supreme Court is separately weighing whether Trump can continue to use these emergency tariff powers.
And that was CTV's Rachel Aiello. Well, the U.S. Environmental Protection Agency is rescinding a legal finding to limit the heat-trapping pollution that spews from vehicle tailpipes, oil refineries, and factories. We get more on this from CTV's Jeremy Sherrill.
This is significant. This is a rule that was used to underpin climate policies in the U.S. and emissions regulations, not just in the auto sector, but when it comes to power plants, oil and gas industry facilities, any kind of pollution. This is the ruling that was used to justify some of these regulations that were put in place. And so this is a significant shift in the way the U.S. administration is approaching climate policies. We know that in the past, U.S. President Donald Trump has called climate change a con job. And this is, a large-scale deregulation and will significantly hinder the Environmental Protection Agency's ability to put forward policies to impact pollution and to try and limit the greenhouse gases that are being emitted. So this is significant in that it will stop the administration and stop the EPA from moving forward with climate policies. In fact, it will retract a lot of the climate policies that were in place. And then it has a significant impact on the auto sector, where it means that moving forward, auto manufacturers will have different rules and regulations to follow, less stringent rules and regulations. And the administration made it clear in this announcement that they are looking to take the pressure off the auto sector from producing more low emissions vehicles and electric vehicles. So this is a significant decision that will have serious impacts.
Yeah, no kidding. So we know that former President Barack Obama obviously established that framework in 2009. Has he responded at all to this repeal? And what's been other responses we've been getting from maybe the public?
Yeah, he has and has pushed back, understandably. As you've touched on, in 2009, it was under his administration that this rule was put in place. He took to social media to call this out, in part saying that without it, we'll be less safe, less healthy, and less able to fight climate change. Also, the fossil fuel industry can make even more money. That's former U.S. President Barack Obama saying that. What we've also seen is large climate institutes in the U.S. Already come out against this and have said that they have been working for some time to prepare for the possibility of this repeal and to sue over the decision to repeal this rule. So certainly I think we can expect pushback. The Sierra Club, which is the largest environmental group in the U.S., says that Trump has formalized climate denialism as official government policy. So certainly there's a lot of pushback here, Lindsay, and I think that we can expect to see, legal pushback as well. This won't be the end of this story necessarily.
And just lastly, too, we saw the Environmental Protection Agency's administrator, Lee Zeldin, accompanying the president yesterday. He was calling this the repeal the largest deregulatory action in American history. So I wondered, does this have any effect on Canada moving forward as well?
I think it absolutely does, because you look at the fact that Canada and the U.S. in the past have been pretty lockstep when it comes to climate policy, specifically when it comes to emissions regulations in the auto sector. The North American auto sector as a whole had been, cohesive. That is changing, of course, with tariff policies and stuff. But now we're going to see a serious decoupling of that, and we're going to see significantly different emissions regulations in the U.S. and Canada, which could cause a few different things. It could, make it difficult for Canada to enforce its now more stringent emissions regulations, but it could also stop our country from importing certain vehicles that are now going to be manufactured without these regulations. So there are certainly many scenarios, and I think certainly it is likely that this has, in the long term, if this decision remains, that this has a significant impact on the auto sector and how many vehicles we bring in. I think it's hard to imagine a world where the big auto manufacturers in the U.S. start manufacturing one version of a vehicle for the U.S. and then another for Canada. It's probably not worth it for them to do so. So the more likely scenario is Canada's forced to import vehicles that don't meet the regulations that exist here, or they stop importing those vehicles, right?
Lindsay was talking to CTV's Jeremy Sherrill. Market calls up next, and joining us today, Nadeem Kassam. He is Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Council. His focus, North American equities. And before we go, let's take a quick look at the market, see how Bay Street is doing. It's been a bounce back from yesterday. You can see that. Look at that, up by almost 1.7%. Leading the way, materials, the miners are surging right now. But one of the ones that also is having a great day right now, if we can pull this one up, is Magna International. It's up. It was up over 18, 19%. It's up 17.5% right now, and that's based on its earnings and its sales forecast for 2026. Some of the analysts saying it was just one of the biggest surprises yet, a monster Q4 on some of the numbers, and the price targets have surged based on that. So Magna International leading the way. Taking a look south of the border, and a bit of a mixed bag. Okay, now we're back, everybody into the green. It's been up and down all day. S&P 500 up by 0.57, the Dow by 0.47, NASDAQ by 0.38. And that's it for Morning Markets. I'm Roger Peterson. Thanks for joining us. Have yourself a great weekend.